In this example, we're going to walk through how to recognize income on a long-term contract using the percentage of completion method. We have long-term contracts when they're for specific customers, in other words, not making inventory for resale, and the term of that contract extends over one accounting period. Let's go ahead and take a look at how we do that. We're given information on costs incurred to date, estimated cost to complete, billings to date, as well as collections to date. The important thing to consider is we're going to recognize revenues and expenses as well as profits based on a proportion of the cost we've incurred. We're using cost as a measure of the work that we have completed. Keep in mind, normally, it doesn't matter when we bill our customer or collect cash. We don't recognize revenues when we get the cash. Rather, we recognize revenues when we perform the service or deliver the goods. In our percentage of completion method, we're assuming we're completing work on the contract, in other words, performing as a service in proportion to the cost that we incur. So in our contract, we've got the Teal Company has started a construction job with a contract price of $1 million in 2020 and an estimated cost of $800,000. So what's our overall profit and what's our overall cost? Again, in terms of cost incurred to date, we've incurred $200,000 in the first year. We estimate $600,000 to complete for a total estimated cost of $800,000. So our estimated profit on this contract is $200,000. Now we've incurred $200,000 out of the $800,000, or 25% of our cost. We still have another 75% of the cost to do. But because we've recognized or incurred 25% of our cost, we get to report 25% of our revenues. So our revenues to date will be $250,000, which is 25% of the $1 million. Our current year's revenues then will be the $250,000. So in terms of our journal entries, we will recognize a $250,000 in revenues. Again, 25% of the work, we will record 25% of the revenues, and we will report 25% of our profit. So our construction costs, we were told, were $200,000. So our cost to date, $200,000. We are going to record that as a debit to construction expense, as well as a debit to construction in process and an accounts payable. If we want to think about the incurring of our construction cost, think about it this way. In a manufacturing environment, as we incur cost, in other words, accounts payable, wages payable, utilities payable, etc., we debit work in process. Here we are debiting an asset account called construction in process, and we can see that right there. Let's go ahead and take a look at how that impacts our accounting equation. In terms of our accounting equation, we're going to report 25%, or $250,000 in revenues. We're going to report a cost or an expense equal to the construction cost we've incurred. That's the $200,000 in expenses. So we would have $50,000 in profit, which of course increases retained earnings. To keep our balance sheet in balance, we need to debit something for $50,000. And that $50,000 something will be construction in process. The thought being that we incurred $200,000 in actual cost, there it is, and we've increased the value by an additional $50,000. That's how much we're going to eventually perhaps bill the customer. Now, in terms of billings on long-term contracts, they really have nothing to do, or probably in terms of the contract, they have something to do with the work we perform, but it can be different than the amount of cost we incur. In this particular problem, we're assuming we're going to bill $200,000 in the first year. And of course, whenever we bill anyone anything, we debit accounts receivable. On our construction contracts, the interesting thing will be a credit to billings on construction in process. We've really already reported our revenues, so we can't credit a revenue. So we debit billings on construction in process. Notice what that does to our balance sheet. Our balance sheet will show construction in process an asset of $250,000 a billings in construction and process, which is a contra account, of $200,000. So we have net work in process or construction in process of $50,000, and we have a receivable of $200,000. If we hadn't billed the customer, we wouldn't show anything as accounts receivable, and instead we wouldn't show the entire $250,000 as construction in process. But since we've billed our customer $200,000, we essentially shift $200,000 in assets from construction and process up to accounts receivable. And of course, whenever we collect on receivables, we debit cash and we credit accounts receivable. Let's go ahead and take a look at our entries for the second year of our contract. The first thing we're going to want to do at the beginning of year 2 is pick up our beginning balances for construction and process, and on our contra account, the billings on construction and process. So we've picked those up. Let's go ahead and see what happens in year 2. In year 2, which is 2021, we've now incurred a total of $720,000 in construction costs. So our current year construction cost would be the $720 minus the $200 from last year. So the current year's construction cost is $520,000. Of course, when we incur that cost, we debit construction and process and asset account and credit our accounts payable for $520,000. Now, we're also at this point in time estimating it's still going to take an additional $180,000 to finish this contract. So notice, our estimated cost to complete is now $900,000 for total cost. So we will only have an estimated profit of $100,000. Now, to date, we've incurred $720,000 out of the $900,000 in total estimated cost. So we've incurred 80% of our cost. So we will report 80% of our contract revenue. 80% of the $1 million is $800,000. Now, last year we reported revenues of $250,000, so the current year's revenue will be the $800,000 minus the $250,000, or $550,000 in additional revenue. We had $550,000 in additional revenue. We've got $520,000 in additional cost, which means that we will need to report this year's profit of $550,000 minus the $520,000 is $30,000. We didn't put it here, but last year we had $50,000 in profit. And notice, in total we will have reported $80,000 in profit, which is 80% of our cost that we've completed. So in total, we would have reported 80% of our revenues. We would have reported 80% of our cost, and combined over time, 80% of our profit. So what do we got going on this year? Again, we will record an expense equal to the construction and cost that we've incurred, so $520,000. Again, debits don't equal credits, and we need an additional $30,000 in profit. Once again, taking a look at our accounting equation. What went on this year? $550,000 in revenues, $520,000 in expenses, which means net income went up by 30. We've got to have an increase in assets. So again, the thought is we incurred $520,000 in construction costs, and we would debit construction and process. But on top of that, we added an additional $30,000 in value, which we will eventually bill our customer. So we increased our asset this period by the $550,000. So we've got construction and process of $800,000. Now, when we bill our customer, and in this case we are decided we have billings to date of $700,000, so 700 minus the 200, we've got additional billings this year of what? 500,000. We send out those bills and we record a credit to that contra account. On our balance sheet, what does it look like now? We've got Construction in process, $800,000. In other words, we've incurred cost and or recorded profits of $800,000. We have billed out $700,000 of that, leaving us a net asset of $100,000. Let's take a look at the last year on our contract. We begin by picking up our beginning balances for billings on construction in process as well as our construction in process. We have now incurred a total of $900,000 in cost. We estimate no additional cost to complete, so we've got a total cost of $900,000. And we will recognize an estimated gross profit of $1 million minus the $900,000, $100,000. We've incurred 100% of our estimated costs, so we will, of course, by the end of year 3, we will have reported 100% of our profits, 100% of our cost, and 100% of our revenues. Current year's costs. Current year's cost, total cost of $900,000. Minus the cost that we incurred in prior years of $720,000. Our current year cost is $180,000. We debit construction in process, we credit accounts payable, and of course we record that $180,000 as a construction expense in the current period. How much do we get to report in revenues? Again, we've completed 100% of our project, so we get to report 100% of our revenues, or the full $1 million. In prior years, we've reported $800,000, so this year's revenues on our long-term contract will be the $1 million minus the $800,000, or $200,000. And our profit is the $200,000 minus the $180,000, or $20,000. If we wanted again to take a look at our accounting equation, what's going on? We reported revenues of $200,000, costs of $180,000, a profit of $20,000. That profit will make retained earnings go up. To keep that in balance, we debit construction in process. And again, the thought is, during the current period, we incurred $180,000 in construction cost. Of course, that increases an asset. That's our work in process, our construction in process. We added an additional $20,000 in value that we're going to get to bill our customer. So what do we notice? If we look at our construction in process account, we see it has a total balance of $1 million. We've only billed our customers $700,000, but in this third year, we get to bill an additional $300,000. So we're going to bill our customer $300,000. So we credit billings and debit accounts receivable. What do we notice now about our construction and process account? It has $1 million balance. And at the end of our contract, our billings account will also have $1 million balance. Once we've completed our contract, we of course want to zero these out. So we're going to need to credit construction and process for $1 million. And to close out our billings on construction and process, we would need to debit it for $1 million. That will effectively zero out our construction and process and billings on this particular job. As we continue to collect cash on our job, we of course debit cash and we credit accounts receivable. This year we collected an additional $250,000 in accounts receivable. So we will debit cash and credit accounts receivable. Hopefully they will pay us the additional $900,000 next year. Let's consider another contract, one where we expect to earn no profit. Why we would do this, I don't know, but we're just going to assume there's no expected profit from the start. So in other words, we expect to incur $1 million in cost, and we have revenues of $1 million. Well, in this case, after 1 year, if we have completed 20% of the work, we will report 20% of the revenues. And since we've incurred 20% of the cost, we will find we have no profit to report. And what would it look like? Here are our basic journal entries. Again, we've incurred $200,000 in cost, so we record that as an expense. If we don't expect to earn any profit from the contract, we will just report 20% of the contract revenues of $200,000. So there is no profit whatsoever. Let's consider one more scenario, and this is a loss scenario. Let's say we anticipate a total contract cost of $1,050,000 now on $1 million contract. Well, if you recall, when we had no profit on the contract, we reported our revenues of $200,000, our construction expense of $200,000, and no profit. If we expect to report or incur a loss on the contract, we're going to want to report a cost equal to or an expense equal to the cost we've incurred, so $200,000. But we're also going to want to increase that for the amount of expected loss. We record all of the loss as soon as we expect to incur it. So it could be at time 0, it could be after 1 year if we start having cost overruns, after 2 years if we have cost overruns. But in any event, we're expecting now a loss of $50,000. So what do? We've incurred expenses of $200,000. We want to increase that by the amount of our expected loss, $50,000. Again, don't pay too much attention to our numbers up here. I haven't necessarily changed everything directly. But again, we incurred $200,000 in costs. We grossed that up by our expected loss. Debits don't equal credits, so we need to credit something, and we will credit the exact same account, construction in process, for $50,000. So we've incurred $200,000 in cost, but we expect a $50,000 in loss. So at the end of that first year, we will only report a construction asset of $150,000, because as we continue to incur cost on our project, and at this point in time we expect to incur what, an additional $850,000 in costs? Well, 850 plus the 150 gives us our contract revenues of $1 million.